Welcome to Taking Stock for the week ending the 7th of August 2026. My name is Jason Yin, and joining me today is my colleague Charlie Song. Welcome to the episode, Charlie.
Thanks for having me, Jason.
Now, before we begin, today's discussion is general in nature only and doesn't consider your personal financial circumstances. Nothing that we discuss should be taken as personal financial advice or as any recommendation to buy, hold, or sell any security. Now, Charlie, artificial intelligence has once again been the big story in global markets this week, but it feels the conversation is starting to change a little.
Yeah, it certainly is, Jace. Investors aren't just asking how quickly AI revenue can grow. They're starting to focus on what the growth will cost and whether companies will earn an attractive return on all the money they're investing.
Yeah, and Google really brought that issue into focus this week. The company has spent around $45 billion in capital expenditure during the quarter, and this was largely on servers, data centers, and also networking equipment. Cloud growth was strong, but that spending still exceeded quarterly operating cash flows, which is quite interesting.
Yeah, and Microsoft's result was perhaps a little more reassuring. Azure growth accelerated, so there's clearly no shortage of cloud demand. In fact, the problem is that Microsoft still doesn't have enough infrastructure to meet it.
Right, which seems to explain the continued spending that the company continues to commit to, but that doesn't entirely remove the risks, does it?
Exactly. And strong demand is encouraging, but shareholders ultimately need that investment to produce cash flow, not just revenue growth.
That's right. And we saw a similar tension in SpaceX's first earnings result as a listed company. Revenue grew strongly, and that was supported by Starlink and also its emerging AI business. But the company did spend around $18 billion during the quarter, which was mainly on AI infrastructure.
Yeah, and that didn't sit well with investors because the spending is still far ahead of the earnings being generated.
Hmm.
SpaceX wants to expand its data center capacity significantly and has even discussed putting computing infrastructure into orbit.
Yeah, that seems quite sci-fi, doesn't it? Which is a pretty extraordinary idea, but presumably there will be a massive price tag around that, wouldn't it?
Absolutely. And that sums up the broader AI debate. The demand clearly is real. The opportunity we think is going to be enormous, but companies are committing hundreds of billions of dollars already. And that's just, we're probably just at the start of this. So
Mm.
it's very hard for anyone to know what the eventual returns will look like.
Mm.
So perhaps the question really is, it's not really will AI grow, but how much that growth will turn into sustainable cash flow in the future.
Yeah, and I think that's a really important lens for this week's company updates as well. So, kicking it off, we've got SKS Technologies. Now, the company upgraded its guidance ahead of its full year result. Management now expects unaudited profit before tax of around $40 million, which is up 16% above its previous guidance of around $34 million.
Yeah, and what stood out to me, Jason, was that the revenue was only modestly ahead of guidance at around $348 million. The bigger improvement actually came from margins, which increased from 10% to 11.3%.
Yeah, that's also a pretty interesting note that you've said right there. But was it simply a case of just selling more or also doing more work?
No, and that's what makes that update encouraging.
Mm,
SKS appears to be delivering projects more efficiently and
right.
controlling as well. Its investments in people, systems, and processes may also be helping it grow without overheads rising at the same price.
Right. So project execution is definitely something that's key right there. And also, it's something central to the next company, which is Monadelphous. Now, the company has secured a $200 million contract from BHP at the Nelson Point iron ore export facility over in Port Hedland.
Yeah, and that work involves installing and commissioning a new railcar dumper and related materials handling infrastructure. It has already begun and is expected to continue until 2028.
Right. So how significant is this contract for Monadelphous?
Well, it's equivalent to roughly 9% of annual revenue. And although that income will be recognized gradually over the project's life, it also follows another major contract from Rio Tinto, giving Monadelphous better visibility over its workload for the next couple of years.
Right, so the demand curve is definitely there from the big miners. And the challenge has always been with these large contracts is obviously delivering on time and also delivering on budget as well. What's Monadelphous doing in this regard?
Well, they need to manage labor, materials, and costs carefully, and Monadelphous has a solid record of execution on that front and continues to generate strong cash flow. The growing order book also supports its dividend outlook, with the shares offering a forward gross yield of around 5%.
Right, to sum it up, the company is clearly benefiting from a lot of the continued investment across the mining sector. And that takes us to one of its major customers that you've mentioned before, Charlie, which is Rio Tinto. And the company delivered a pretty strong first half result this week.
Yeah, it did, Jace. And what stood out wasn't Rio's traditional iron ore business, but it was the growing contribution from copper and aluminium.
Right.
Together, they generated almost 60% of underlying group earnings during the half.
Yeah, and that's a pretty significant shift for a company that investors have traditionally tied or viewed as an iron ore producer, right?
It is, and higher copper prices and stronger production from the Oyu Tolgoi underground mine both helped. Rio is also seeing the benefits of its focus on productivity there.
Yeah, but let's not forget the iron ore still contributes almost half of group earnings, so it's still quite substantial there as well. We also have to be cognizant that Chinese steel demand and any additional global supply remain important risks to the company's near-term thesis.
They do, and the elevated level of short interest suggests more some investors remain cautious, but as copper, aluminium, and lithium become more meaningful, Rio should become less exposed to the fortunes of any single commodity.
Right. To sum it up, it seems like the investment case for Rio Tinto is gradually changing from predominantly an iron ore producer to an income story and perhaps to a more diversified resource business, right?
Yeah, and I think that's something the market's been grappling with over the past 12 months. And they've been starting to view Rio a bit differently from maybe how they viewed Rio in the past.
Right, that makes a lot of sense. All right, so turning from commodities to property, we've got Charter Hall Social Infrastructure REIT, and that company also delivered a pretty solid FY26 result, Charlie.
It did, and operating earnings increased almost 13%, while distributions rose to 17 cents per unit, and net tangible assets edged higher after a positive property revaluation.
Right, when I was reading through some of the result, the interesting part that was flagged was that the company is changing its portfolio composition.
Yeah, and it's selling 86 early learnings properties at an average yield of just 4.4% and
Right.
reinvesting that into 11 properties, much bigger ones, at an average yield of 6.2%. So that higher return on the reinvested capital should support future income, but also shows
Mm.
that there's parts of the portfolio that are doing really well, and there are opportunities in the market that CQE would rather buy into at this point. CQE is now guiding to operating earnings growth of at least 4.6% and distribution growth of almost 6% in FY27. So I think that remains the main appeal for this company. So it's got predictable income from essential service tenants on long leases, but it's also got that upside of capital recycling.
Yeah, those are pretty high hurdles for any competitor to sort of overcome. So it's one of the reasons why we continue to like this REIT. Now, capping off this update session, we've got a quick comment on Steadfast. The bidding consortium has maintained its $6 per share takeover proposal after reviewing the company's financials and operating information, which is a positive that they haven't pulled out of this deal.
Yeah, and the exclusivity period has been extended to 19th of August while the parties work through documents and approvals. It's a positive sign, but investors should remember that the proposal isn't yet binding and would still require regulatory and shareholder approval.
Right, for Under the Microscope this week, we are going to take a closer look at REA Group, which is the operator of the website realestate.com.
Yeah, and it was another strong result. Core revenue increased 7% to almost $1.8 billion, while underlying net profit rose 15% to $651 million.
Yeah, and it's obviously quite interesting given the fact of what's happening in the real estate market right now. From the data that we have seen, Australian residential revenue growth expanded even faster, and that was up 12%, despite, as I said, the macroeconomic and the property backdrop being rather flat. What does this tell us about the company moving forward, Charlie?
Yeah, well, it tells us that REA is earning more broadly from the same number of advertisements.
Right.
Revenue per residential listing increased 13%, and that was driven by price rises, but also a greater use of premium products and a stronger adoption of optional add-ons.
Yeah, and that's always been a characteristic for REA. The company has always managed to pull price increases across the board, and that has supported revenue growth. But I've also noticed that some of the costs have increased a little bit more slowly than profit, which has been ideal. And the Australian operating margin obviously reached 66%, which has been quite exceptional.
Yeah, and free cash flow also increased 17%, supporting a 20% dividend increase and the completion of a $200 million share buyback.
Yeah, some investors would be obviously very excited about that juicy buyback. The company ended the year with 366 million in cash and no drawn external debt. So financially speaking, it's in a very strong financial health position. But what could derail some of the momentum going forward into FY27?
Well, listing volumes are probably the main issue at this point, Jason, and REA expects national listings to be flat or slightly lower, broadly speaking. They see Sydney and Melbourne being the weaker points, while Brisbane, Perth, and Adelaide are performing a bit better.
Yeah, and I think that's the interesting point. It's the geographical disbursement between the different and various markets because not every listing produces the same amount of revenue, right?
Yeah, exactly. And Sydney and Melbourne advertisements typically generate more revenue per listing. Even
Mm.
if national volumes remain stable, a shift towards lower price cities could weigh on overall growth.
Yeah, well said. Nonetheless, the company still expects low double-digit growth in revenue per listing, and this is supported by another price increase and also broader adoption of premium products that the company is introducing. Now, for question of the week, this is a pretty interesting topic that we've spoke about at length in the past, Charlie, which is about a company's competitive advantage. Now, one of the factors of a competitive advantage is obviously tied to pricing power. So the question I want to ask this week, Charlie, is how much pricing power is too much pricing power? And just to start off, can you take the audience through what pricing power actually means?
Yeah, pricing power is usually a sign of a strong business. It means the company can raise prices without losing too many customers, often because it has a trusted brand, a valuable product, or limited competition.
Right, so that's a pretty interesting concept. Now, if we were to use REA as an example, I think it sort of fits into that mold because a lot of real estate agents want obviously the largest possible audience of buyers, and realestate.com offers that as a platform, which is pretty difficult for other competitors to replicate at this juncture.
Yeah, but one thing we do note is that pricing power only lasts while customers believe they're still receiving fair value. So if price rises faster than benefits, behavior may start to change.
Right. So now we need to shift the focus away from pricing and obviously into value. And that's probably a pretty interesting point. How do we think about what value a company produces compared to obviously the costs that a company is charging for that, Charlie?
Yeah, well, investors need to look beyond the price increase itself. Are customers staying? Are they buying more products? And more importantly, are they getting better results?
Right. And that's probably the thing that we should latch onto because customers pay a price to get a result. And if they pay a price and the result is not commensurate of what they pay, then obviously value is not right there.
Yeah. And with listings subdued in REA's case and another price rise ahead, the next test is whether agents continue to feel that the additional cost is worthwhile.
Yeah, and that's perhaps the broader question for investors. When does pricing power stop demonstrating that strength in terms of a competitive advantage and also start giving customers and competitors a reason to potentially find an alternative?
Yeah, there's no simple answer, is there here, Jace? But the
No.
warning signs usually do appear in customer behavior. If customers begin cutting back, questioning the value that they receive, or looking more seriously at alternatives, the company may have pushed too far.
Right. So it's a bit of tug and pull right there. So pricing power really shouldn't simply be how much a company can charge. It's the real strength that lies in how long it can raise prices with while continuing to deliver genuine value.
Yeah, and look, to reiterate with REA, the business has been doing really well, and
Mm.
customers have been upgrading their products and buying more add-ons from REA. So that's something that is a positive sign that pricing power can actually continue over the short to medium term, but something that investors will have to keep an eye on.
Well, and that's probably a good point to finish on. So that's all we have for this week's Taking Stock. Thank you so much for joining me, Charlie.
Always a pleasure, Jace.
And to all our members watching, if you know someone who could benefit from learning more about the Stock Doctor platform, we would really appreciate an introduction. You're welcome to contact Charlie or myself directly, and we'll be happy to take that conversation. So until next time, have a happy, healthy, and prosperous week ahead.